Welcome back. Today is not a hot tip show. This is a pullback show, a market selection show, a survival show. Because when the market is sliding, the game changes. The loudest people online start shouting about bargains. The reckless people start calling every dip a gift. And the people who lose the most usually make the same mistake. They confuse movement with opportunity. Right now, that is dangerous. Because this market is not asking for blind confidence. It is asking for patience. It is asking for discipline. It is asking one simple question. If money is getting tighter, if headlines are getting heavier, and if big institutions are still defending only a small group of stocks, how do you find the names that are holding up before the next real move starts? That is what we are doing today. And just quickly, before we go deeper, most people who watch these videos still have not subscribed. So if these breakdowns help you think more clearly, support the channel, subscribe, and drop a comment, even if you just write Our John AG, so the algorithm knows you value this content. Now let's set the table properly. The market has already shown real stress. Reuters reported on March 26th that the Nasdaq confirmed it had moved into correction territory. A day later, Reuters reported that the Dow also slipped into correction territory. And on March 30th, three of the simplest market trackers were under pressure again, with SPY at 634.09, QQQ at 562.58, and DIA at 451.39, all down on the day. Reuters also reported that Morgan Stanley cut global equities to equal weight because war-driven uncertainty and the oil shock were making the risk picture darker. So this is not a fantasy environment. This is not one of those easy periods where you can buy almost anything with a nice chart and expect the market to carry it for you. This is the kind of environment where exposure should stay light, where watch lists matter more than ego, and where the best traders are not trying to prove how brave they are trying to prove how selective they can be. That is the whole point of today's script. Not to tell you that the bottom is in. Not to tell you that every pullback is a blessing. Not to tell you to rush into the market with both hands. The point is much simpler than that. If the market is pulling back, but a small number of stocks are sitting close to support and refusing to break apart, that behavior matters. Because weak stocks do not act that way. Stocks with no sponsorship do not act that way. Stocks with no institutional interest usually do not sit calmly near important moving averages while the rest of the market is acting nervous. So what do we want? We want stocks that are liquid. We want stocks that institutions can actually buy. We want stocks that are not penny names, not random illiquid stories, not thin charts that can jump or crash on one order. We want names that are holding up near the 50-day moving average or on the weekly chart near the 10-week line, because those are the places where stronger stocks often reveal themselves during market stress. That does not mean every stock near the 50-day line is special. Let's be very clear. A stock can sit near support and still fail. A stock can look calm and then break hard. A stock can show one strong day and then vanish into the crowd. That is why a screen is not a magic button. It is not a promise. It is a filter. It is a way to reduce noise so you can focus your energy on the names that are acting better than the market around them. And that is where most people get this wrong. They think a screen is supposed to hand them a winner. It is not. A screen is supposed to hand you a short list. Then your real work starts. You study the chart. You study the shape of the pullback. You study whether volume is drying up in a healthy way or exploding in a dangerous way. You study whether the stock is hovering around support because funds are quietly stepping in or because nobody cares enough to sell it yet. Those are very different things. My basic view is simple. In a pullback, I want low exposure and high awareness. I want to know which names are staying close to their key lines. I want to know which names still have quality ratings, improving ownership, and enough liquidity for serious money to move in and out without breaking the chart. And I want that list ready before the market gives a better signal, not after the easy part is already gone. So let's walk through the logic in plain language. First, I do not want ETFs in this screen. This is about individual stocks, because the goal is to find specific leadership, not broad baskets. Second, I want price above 15. That keeps us away from the lowest quality junk where the moves can look dramatic but often mean very little. Third, I want some sign of accumulation, because if there is no sign that larger players have been involved, then why should I care now? Fourth, I want real liquidity. I am not interested in names where one large order can twist the whole chart. And fifth, I want the stock trading above the 50-day line, but not stretched far above it. Close enough to support that it still feels controlled. Close enough that if institutions are defending it, that defense can actually be seen. That distance matters, because when a stock is 10 or 15% above the 50-day line, it may still be strong, but it is no longer the same setup. Now it is extended. Now your risk changes. Now you are chasing, not preparing. In this kind of market, preparation beats chasing every single time. Then there is quality. I still want strong overall ratings. I want the stock to rank well against the wider market. Maybe not every name has to be perfect. Maybe not every box has to glow green. But the overall picture should say the stock belongs in the stronger part of the market, not the weaker part. Think of it this way. If the whole room is under pressure, I want the people still standing up straight, not the people already leaning on the wall. And this is exactly why the 50-day moving average matters so much. People talk about moving averages like they are magical lines. They are not magical. They are reference points. They are areas where trend, behavior, and expectation meet. When a strong stock pulls back into that area and then starts acting quietly, it often means somebody is there. Maybe a fund, maybe several funds, maybe institutions that missed part of the move and are now using market weakness to build size. You do not always know that with certainty in real time, but the behavior leaves clues. You see it in tight closes. You see it in controlled pullbacks. You see it when the stock does not collapse even though the market gives it every excuse to do so. You see it when earnings come out and the stock absorbs the news without losing structure. You see it when the relative strength line remains firm. You see it when ownership trends keep rising quarter after quarter. None of those things alone is enough, but together they start building conviction. That word matters, conviction. Not excitement, not hope, conviction. Because good process is not about finding perfection. It is about stacking enough evidence that you can say, this stock deserves a place on my list. This stock is behaving differently. This stock may not be ready today, but if the market improves, it is one of the first names I want to revisit. And that is an important mindset shift. In a weak market, the screen is not mainly for buying. It is for tracking. It is for preparation. It is for saying, if the market follows through later, which stocks already showed me their character while conditions were rough? Those are the names that matter most. By the way, if you are serious about following these setups in real time, check the WhatsApp channel as well, because that is where quick updates, short notes, and fast reminders become useful when the market starts moving faster than a long-form video can keep up with. Now let's talk about what a good result can look like. Suppose the stock appears on the screen. It is above the 50-day line, but only slightly. It is liquid enough. It has strong ratings. Its accumulation picture is solid. Its chart is not wild. Then you open it and see something constructive. Maybe a cup with handle. Maybe a tight area after earnings. Maybe 4 weeks of support above the weekly line. Maybe a relative strength line that is already near highs, even though price is not fully broken out yet. That is interesting. Not because it guarantees anything, but because it suggests the stock is not acting like a random name. Patterns matter, but not in the cartoon way many people think. A pattern is not just a pretty shape. A pattern is the visual record of pressure, support, hesitation, absorption, fear, and demand. A cup with handle is not important because somebody gave it a catchy name. It is important because it often shows a stock that corrected, repaired itself, tightened up, shook out weaker hands, and then tried to get ready again. That handle section especially can matter a lot, because it is often the part where weaker holders lose patience and step aside. That can clean up the chart before a new move. But again, no pattern should be treated like a guarantee. This is where discipline matters. A stock can have a beautiful base and still fail if the market is not ready. A stock can have an excellent story and still go nowhere if demand does not return. A stock can have perfect-looking numbers and still break support if sellers hit the whole sector. So even when you see a very attractive chart, you do not marry it. You monitor it. This is also why I care about liquidity more than some people do. Because if large buyers cannot build positions smoothly, the stock becomes harder to trust. I want names where serious money can participate. That does not mean only giant mega caps. It means tradable names with real daily volume, the kind of charts where institutional interest can show up without turning the whole setup into chaos. Then there is relative strength. If a stock's relative strength is high while the market is under pressure, pay attention. And if that relative strength line is pushing into new high territory before price is fully broken out, pay even closer attention. That is often one of the most useful tells in the whole process. It is the market quietly saying, this stock is outperforming even before the crowd notices. That does not make it untouchable. It makes it relevant. The same goes for signs of sponsorship. If fund ownership is rising quarter after quarter, that is not just a random data point. It tells you the stock is attracting larger money. And no, funds are not always right. They can be late, they can be wrong, they can chase. But when ownership is expanding steadily, it still tells you something important. Serious capital has noticed the name. That matters far more than 1,000 emotional comments online. And this is another place where ordinary investors can improve quickly. Stop asking only, do I like the story? Start asking, who else is validating this story with real money? Because in the market, opinions are cheap, positioning is expensive. Ownership trends, relative strength, and support behavior often reveal more than the loudest bullish argument ever will. Now let me slow this down even more and make it practical. If the market is in a pullback and you are keeping exposure very low, you can still do useful work. You can run this kind of screen every couple of days. You can refresh the results. You can see which names keep returning. You can see which charts stay constructive. You can see which stocks lose their shape and disappear. That process alone can teach you a lot. Because strong names tend to keep showing up. Weak names tend to break down, fade out, or lose their ratings. In other words, repetition is part of the edge. A single screen result means little. A stock that keeps appearing, keeps holding support, keeps showing strength, and keeps attracting ownership starts to build a case. That is the kind of case you want before you commit capital in an uncertain market. And while you are doing that, keep your language honest. Do not say, this stock is definitely going to explode. Do not say, this is the next monster winner. Say something more grounded. This stock is acting well. This stock is close to support. This stock is on the list. This stock deserves attention if the market improves. That kind of thinking protects you from the emotional damage that comes from expecting certainty where none exists. Now here is where the average investor usually gets impatient. They ask, if you like these names so much, why not just buy them now? The answer is simple. Because stock selection and market timing are not the same thing. You can have a good stock in a bad market and still lose money. You can identify a future leader too early and sit through unnecessary damage. You can be right on the name and wrong on the timing. That is why low exposure is not weakness. It is strategy. And this is where I want to politely say something to the audience. If you are one of the viewers who has been doing well, if you have been following a process, cutting losses properly, staying patient, or even improving your discipline, share that in the comments. Real success stories help other people stay focused, and they remind newer viewers that progress is possible without gambling. Now let's go one level deeper, because there is another trap here. When people hear support at the 50-day line, they often assume that line must hold no matter what. No, not at all. Support is not a promise. It is a test. It is simply the area where buyers have a chance to defend. Sometimes they do. Sometimes they do not. What matters is how the stock behaves there. Does it undercut and recover? Does it close tightly? Does volume dry up? Does it show accumulation later? Or does it break hard on heavy trade and tell you the sellers are still in charge? Those details are everything. The same goes for earnings. A stock that reports earnings and holds together well in a weak tape deserves a closer look. Why? Because earnings can expose weakness fast. If a stock gets news, absorbs it, stays firm, and does not lose structure, that tells you demand may be stronger than you assumed. Again, it is not enough on its own, but it belongs in the evidence pile. Then there is the issue of perfection. I do not believe in perfect stocks, I do not believe in perfect setups, and I do not believe serious investors should waste time searching for flawless charts with flawless numbers and flawless stories. That is a fantasy. Real market work is about building a balanced case. Maybe the composite rating is excellent, but the up-down volume ratio is only decent. Maybe the chart is tight, but the market is still weak. Maybe the sponsorship is rising, but the sector is not yet in favor. Fine. That is real life. You are not trying to find an angel. You are trying to find a stock that still deserves your attention despite an imperfect world. And that is also why I like to understand the company in normal language, not just market language. What does it actually do? Who are its peers? Why is the group strong or weak? What is the simple story behind the numbers? Because a chart can get me interested, but understanding the business can help me stay grounded. You do not need to become an expert in every line item, but you should know what you are dealing with. This matters even more in a pullback because weak markets expose weak narratives fast. If the story is fragile, the stock often tells you. If the story has real demand behind it, the stock often tells you that too. Sometimes not immediately, but over time, the chart, the ownership, and the behavior around support start speaking the same language. Now let's return to the broader market for a second, because context is everything. Reuters said the Nasdaq's correction signal was confirmed on March 26th, and Reuters said the Dow followed into correction territory on March 27th. Morgan Stanley's move back to equal weight on global equities on March 30th also tells you that even large institutions are becoming more careful in this environment. Why does that matter? Because when the market backdrop gets heavier, your standards should go up, not down. This is not the time to loosen your rules because you are bored. This is not the time to invent strength where there is none. This is the time to say, if I'm going to pay attention to a stock at all, it needs to earn that attention. So what earns attention right now? A stock above the 50-day line, but not too extended. Strong relative strength. Healthy accumulation signs. Good enough liquidity. Rising sponsorship. A chart that is tightening, not unraveling. A pattern that looks constructive, not forced. A reaction to earnings that does not damage the structure. Those are the kinds of clues that matter in a pullback. And what does not earn attention? Thin names with weak volume, stocks already far below support, names that need a miracle to look healthy, low-priced junk, random bounce charts that look dramatic for a day and then disappear, stories with no sponsorship, setups where you have to argue with the chart to stay bullish. If the market is making you work that hard to defend a name, it is probably not the right name. One more thing. A watch list is not a passive object. It is a living document. It changes. Names come on, names come off. A stock that looked great last week can lose structure this week. A stock you ignored last week can tighten up and become interesting this week. That is why rerunning the screen matters. That is why reviewing the charts matters. That is why process beats memory. And yes, by the time many of you are watching this, the members-only video should already be live. So if you want the full update in one place, join the membership and watch that deeper breakdown as well. For premium members, we go further into the market picture, the stronger names, the weak spots, and the setups that deserve more detailed analysis. It also tells me who is really following the work consistently. Now let's talk about the emotional side, because this is where people quietly sabotage themselves. In a pullback, fear and boredom create bad decisions. Fear makes people dump quality names too late, after the damage is already done. Boredom makes them buy weak names too early, just so they can feel active. The screen I am talking about today is one way to fight both of those mistakes. It gives you structure, it gives you a task, it gives you a process that is productive even when your actual exposure stays low. That matters because there is a huge difference between doing nothing and forcing action. Watching carefully is not doing nothing. Building a list is not doing nothing. Studying leadership while the market is weak is not doing nothing. It is preparation. And often, good preparation is what lets you move with confidence later, while other people are still trying to figure out what just changed. Now imagine the market does improve. Imagine we get a better trend signal later. Imagine conditions stop punishing nearly every breakout attempt. At that point, who has the advantage? The person who waited until the headlines felt good again? Or the person who already knows which stocks stayed strong near support, which charts stayed tight, which names kept their relative strength, and which institutions kept adding? The answer is obvious. That is why I like this kind of screen in a difficult market. It turns uncertainty into organized observation. It takes a giant list of stocks and narrows the field toward names that are at least acting worth your time. Not because they are guaranteed to work, but because they are behaving better than the crowd. I also want to say this clearly for newer viewers. If you are just learning, do not overcomplicate it. You do not need 10 indicators screaming at you from every corner of the chart. Start with the basics. Is the market under pressure? Is your exposure low? Is the stock above the 50-day line? Is it close to that line without being too extended? Is volume healthy? Is the chart orderly? Is relative strength strong? Are bigger investors showing up over time? That simple checklist already puts you ahead of most people. And if you are watching all this and thinking, I'm still not sure when to get aggressive, that is fine. You do not need to be aggressive right now. The market is not paying extra points for impatience. Sometimes the highest quality move is restraint. Sometimes the best trade is a better list. Sometimes the smartest decision is to protect mental capital until the tape becomes more supportive. That is also why I keep coming back to exposure. In a clean uptrend, you can press. In a confirmed pullback, you respect the environment. You stay smaller. You stay flexible. You treat every chart with more suspicion, not less. That does not make you bearish forever. It makes you realistic right now. And as you do this work, pay attention to how often the same quality signals cluster together. A stock near support, tight weekly closes, strong ratings, good sponsorship, healthy relative strength, calm reaction to news. That clustering matters, because markets are noisy, but strength often leaves multiple fingerprints at once. If you want one simple sentence to remember from all of this, it is this. In a weak market, your job is not to force winners out of chaos. Your job is to identify the names that are refusing to behave weakly. That sentence can save you a lot of money, because the market has a way of exposing fake strength. A stock can look exciting on social media. It can look explosive in one screenshot. It can trend for a day because somebody pushed a story. But real strength tends to be quieter at first. It tends to show up in behavior, not drama. It shows up in the refusal to break. It shows up in support where there should have been damage. It shows up in rising ownership. It shows up in relative performance before the breakout crowd arrives. And when you start to see that properly, your whole approach changes. You stop chasing noise. You start building evidence. You stop treating the market like a casino. You start treating it like a process of elimination. What should I ignore? What deserves a second look? What has earned a place on the list? What still needs the market's permission before I do anything? That is a much stronger way to think. Also, one more quick thing for the community. If you are someone who has had a genuine win from staying patient, from waiting for better setups, or from managing risk better than you used to, share that below. Those comments raise the level of the whole audience, and they help people understand that discipline is not boring when it starts protecting real money. Here is the twist most people miss. The biggest opportunity in a pullback is not the red screen you are staring at. It is the information hidden inside that red screen. Which stocks are refusing to crack? Which names keep getting bought when the market opens weak? Which charts keep tightening instead of falling apart? Those questions matter. So tell me in the comments, when you study a pullback, do you trust price support more or relative strength more? And what is the one sign that instantly tells you a stock still has serious buyers behind it? I want to know how you see it, because smart communities get sharper when people explain what they are noticing in real time. That kind of feedback helps everyone separate real leadership from random noise before money gets risked. So where does that leave us right now? It leaves us cautious. It leaves us selective. It leaves us aware that the broader backdrop is still heavy. It leaves us with major indexes that have already shown correction behavior and with large firms turning more defensive. It leaves us in a market where low exposure still makes sense. But it also leaves us with a method, a useful one. Find the liquid stocks. Keep the price quality decent. Exclude the noise. Look for accumulation. Focus on names above the 50-day line, but close enough to it that support still matters. Favor stronger ratings. Study relative strength. Watch the reaction to earnings. Monitor sponsorship. Build a living watch list. Refresh it every few days. Let repetition show you who the real leaders might be. That is not glamorous, but it is effective. And when the next better phase finally begins, that work can matter more than any hot take ever will. Because the market often rewards the people who prepared quietly while others were panicking loudly. So no, this is not the time to act like every dip is a gift. This is not the time to confuse a random bounce with true leadership. This is not the time to chase extended charts because you are afraid of missing out. This is the time to get organized, the time to get selective, the time to keep your standards high while your exposure stays low. That is how you survive a pullback without going blind. That is how you build a watch list with purpose instead of with hope. And that is how you give yourself a better chance of being ready when the market finally stops punishing discipline and starts rewarding it again. If you got value from this, subscribe, join the membership, check the WhatsApp channel, and leave a comment below. Tell me which kind of stock behavior you trust most in a pullback, and if you have been seeing success from patience, share that too. I read those comments carefully. Because in a market like this, the people who stay thoughtful, patient, and prepared usually have a very different next 6 months than the people who just react. And that difference starts long before the headlines admit the turn is real. Preparation wins while the crowd still argues about whether the damage matters.